This one, it's NESP project 3.1.6, and it's had a rather narrower remit than some NESP projects, but even within that narrow remit, it's opened out a lot of interesting possibilities and opportunities, I think. But that narrow remit was to look at trading in water quality credits as a potential mechanism for facilitating future expansion, and that's economic expansion along the Reef coastline. And as Nathan mentioned, I would also very much like to thank the funders of this work for giving us the opportunity to undertake this research over the last few years. That's the NESP Tropical Water Quality Hub, which is funded by the Australian government. And also this particular NESP project was co-funded by the Queensland State Government Office of the Great Barrier Reef. So we're grateful, very grateful to both funders for the funding opportunity to be able to undertake this work. And as you'll see there, there's many people who've been involved with this work. It's me that's talking today, but I'm very entirely reliant on the work of my colleagues here who have collectively assembled the information and data which we're going to talk through today. And you'll notice there that it's not just people from the universities here. We've had active collaboration within the project from staff from the Queensland Department of Environment and Science, Alex Gozon-Garcia, Joe Burton, Peter Dew, and Greg Edison have all played very active roles within the project, for which we're extremely grateful. So here we go. So what was this project about? Well, the key question really was, is water trading in water quality credits going to potentially provide a cost-effective pathway to facilitate future economic expansion along the Reef coastline without jeopardizing reef water quality? So this is set really in the future. It recognizes the very substantial investments that the federal government and the Queensland state government have already made and will be continuing to make to improve reef water quality. But it's really looking beyond the timescale of that immediate improvement, beyond the point at which the water quality improvement plans and the end of catchment targets have hopefully been met. What's going to happen after that? Is there effectively going to be a handbrake on any form of further economic development along the Reef coastline? Or is trading in water quality credits a mechanism that could allow that future development to happen without winding back those very hard-won gains in reef water quality? Because obviously we don't want that to happen. We don't want it to be an either-or situation. We don't want either reef water quality or economic development. And the question here is, could trading in water quality credits perhaps be the mechanism that would allow both of those desirable outcomes to coexist? So that's really what this project was chasing. And of course, the answer to that, well, it will depend on the supply of and demand for these water quality credits. And here we're focused particularly on nitrogen and fine sediment as the pollutants of interest, which we would be looking to supply water quality credits for. So it would depend on the supply and demand for those sediment or nutrient credits. And it would also depend on the regulatory and legislative frameworks within which the credit trading can operate. And then it also depends on how credit trading markets would be configured within those frameworks. So that's the sort of stuff we're looking at. And we, in the presentation today, which sort of mirrors the layout of the report for this project, we sort of step through each of those aspects in turn. We first have a look at potential supply of DIN, dissolved inorganic nitrogen credits, from agricultural diffuse sources, and we look at the wet tropics particularly for that one. Then we look at, okay, who might be wanting to buy those type of credits following on from economic expansion. Then we have a quick look at sediment credits, and again, is there a demand or likely to be a future demand for those type of credits? Another thing that we looked at in a bit of detail in the report is looking at supply of nitrogen credits, not just from nitrogen reductions directly, but from reductions in the nitrogen that's associated with fine sediment. And that is, we were very fortunate there to have help from the Queensland DES, who are very active in that type of area. The other thing that we're very fortunate to have is this project is actually be able to draw on multiple findings from many other NESP tropical water quality projects that are coming to fruition now. It's also able to draw on findings from the Wet Tropics MIP and from the Landholders Driving Change MIP. So we're very fortunate to have been able to work with colleagues and collaborators across a range of different projects to bring all this thinking or data and thinking together here. So just to set the scene a little bit, when I talk about this future economic expansion, what's the future that I'm talking about? Well, really, it's essentially the future in which we've already had full adoption of the practice changes that are recommended under the relatively new agricultural ERA standard for sugarcane cultivation, and there's another one for grazing in the GBR catchment. So on the cane side, I'm assuming that that would entail full adoption of the levels of nitrogen practice that would likely comply with a whole of farm nitrogen budget. And I think my next slide, yeah, on this slide, I've just set out the standard practice steps here that were certainly the ones that were in use in the paddock to reef APSIM agricultural simulation modeling that formed the basis data for our nitrogen assessments. But what we see there is we see a progression in practice, which I'm sure many of you are more familiar with than I am, but from outmoded practice really at level D, DF, through to the very best of kind of future practice at level AF. But I've just highlighted in yellow there a switchover, which occurs when instead of at level BP, which is the upper of the yellow highlighted levels you're looking at there. So at that level, nitrogen application rates are still dependent on what's called a district yield potential, a potential yield for the whole of the local area, but then with adjustments made for soil organic carbon and for nitrogen in fixation through legume fallow, and potentially for application of mill byproducts to the land as well. But the key thing is it still relies on that district yield potential as the basis for assessing the fertilizer applications. The next step beyond that, the one at BF there, it no longer relies on the district yield potential, but it relies on historical yield from particular cane blocks. And then it makes adjustments again for legume fallow, soil organic carbon, etc. So there's quite a shift there, in fact. And so the future that I'm talking about, and of course we don't know ultimately whether this future will come to pass, but the future that I'm talking about is one in which at least level BF of practice has been fully adopted across the cane industry. So that's already a reasonably high level of nitrogen management practice. So that was just to tie us into this, what is the future? So we're looking ahead there now. Let's look at the legislative frameworks that are around within which some form of water quality trading could take place. And there are three existing frameworks that are relevant here. The first of them, which NESP was certainly very actively involved in setting up, and I know obviously Reef Trust in the federal government were extremely involved in setting up, is what's called the Reef Trust Offset Plan and calculator. And this refers to activities that actually take place within the GBR Marine Park or Queensland's GBR Coast Marine Park. And so this might be things like marina expansion or port developments, that sort of thing. So there's a hierarchy of mitigation there, where you're meant to, if you're undertaking one of these developments, you're meant to reduce your on-site impact as far as practicable. But then, when it's no longer practicable to do that, you can make a payment in lieu of the unmitigated impacts. You can make that in lieu payment into a Reef Trust account, and then that Reef Trust account will be used to fund improvements in land use or land management back in the catchments that will have the impact of offsetting those unmitigated impacts along the coastline. So that offsetting could be in terms of sediment or DIN or nitrogen or other aspects of biodiversity. So that's what's called an in lieu payment scheme. It's money that goes into a fund. That fund is then used to purchase improvements in land use and land management that reduce the levels of the pollutants of concern and ideally offset the adverse unmitigated impacts along the coastline. A key point there is once the developer has paid that in lieu payment, they're not liable any longer for any potential consequences from the development. The second framework operates within Queensland state planning policy, and that's somewhat similar in concept to the Reef Trust plan. It's an in lieu payment scheme in which urban developers, so this is specifically a housing and industrial type development mechanism within planning policy. So again, you would try to mitigate your impacts on sediment and nitrogen runoff after construction on your sites, but it's only feasible to do that up to a certain point, and unmitigated losses beyond that, consequences beyond that, are again covered by developers making an in lieu payment. But in this case, it goes to local government, and local government then have the responsibility to deliver off-site treatment solutions that could reduce nitrogen or sediment. So that's another bucket into which funding is being delivered, and that funding is used to purchase changes in land use or improvements in land use that offset the unmitigated impacts of the housing developments, etc. And now there's a third one. The third framework is somewhat different. This is the Queensland Point Source Water Quality Offsets Policy, which was revised back in 2019. And it specifically relates to point source emissions that operate under environmental authority. So these are licensed point source emissions of nitrogen and or sediment. And typically you're looking there at things like sewage treatment plants, aquaculture facilities, abattoirs. So they're releasing at the end of a pipe, hence the point source, emissions of nitrogen and or sediment to waterways. Now, there will be they have licensed limits on the concentrations and or loads that they can emit. However, under the point source water quality offsets policy, it offers the opportunity for those point source emitters to offset exceedances on their licensed emissions by purchasing credits in terms of nitrogen or sediment. Now, those credits can be purchased from a trading market under the 2019 revisions to this policy. So that very much opens the door directly to a trading market in water quality credits, where credits in terms of nitrogen reductions or sediment reductions can be purchased specifically to reduce exceedances against licensed emissions of nitrogen or sediment from these point source emitters. Two key things to point out on the way past here. The first one is that to try and ensure environmental integrity is maintained, there are two sort of multiplying factors that are included in the policy that have to or aim to ensure that if you're using diffuse source, so credits that are purchased from agricultural sources, to offset exceedances on point source emissions, then it wants to make sure that the credits that are purchased as offsets are sufficient to ensure that the water quality at the receiving water is actually maintained. So there's what's called the delivery ratio there, and there's another factor called the environmental equivalency ratio. The delivery ratio is configured really to look at uncertainty around the delivery of nitrogen or sediment reductions down a catchment. The environmental equivalency ratio is particularly relevant if we were looking at trying to offset nitrogen reductions via reductions in fine sediment, which carries with it some nitrogen reductions, but are those is that nitrogen reduction really equivalent to what was being discharged at the point source? So we've got two adjustment factors there that are in the policy. Only one of them is really currently being fired up though. That delivery ratio sits at 1.5 to 1, whereas the environmental equivalency ratio sits at 1 to 1. So the delivery ratio means if you wanted to offset 10 kilograms of license exceedance on nitrogen with the delivery ratio at 1.5 to 1, you'd have to purchase 15 kilograms, 1.5 times as much of diffuse source nitrogen credits in order to for that offset to be considered sufficient. Okay, so there's the policy background. Let's have a look then at how did we go with trying to quantify the potential supply of DIN credits from agriculture. And here we're looking specifically at cane, really. And we were looking at a couple of different mechanisms. One would be improvements in fertilizer management practice in cane. The other one would be changes in land use, either looking at set aside or constructed nitrogen treatment systems in the form of wetlands, or some of the other land use changes that that Nathan mentioned earlier there. Here we were very fortunate to have access through Mark Silburn's group and with the assistance of Mel Shaw and Grant Fraser. They give us detailed results from the Paddock to Reef agricultural simulation modeling APSIM of the yields and DIN losses at fine spatial resolution across the wet tropics. So these modeling results predict cane yield and DIN loss for unique combinations of soil type, soil permeability, climate zone, and subcatchment right across the wet tropics catchments. And we ended up with 563 separate management units across those catchments. And for each of those units, at each of these practice levels, for the climate, the weather really, I guess, that happened between 1987 and 2013, we got a prediction of the cane yield and the DIN loss for each of those 563 management units. And we got a prediction of the average DIN loss and cane yield across the different crop stages across those years. So that's the average across years. But we also got individual year results, individual year averages just across the crop stages from the years 1987 to 2013. And what do we do with that? Well, we use that information together with other information in the literature as the basis for figuring out what's the minimum level of compensation that a farmer might want, a cane farmer might want, to change, to agree to change their management practice to improve it, let's say, from DF to CF or from CF to BF. And following quite well-established methods in the literature, we split our estimates of the costs there into 4 components: opportunity cost, compensation for increased risk of a lower yield, transition cost. Transition cost is the cost associated with buying equipment and investing in the technologies that you need perhaps to upgrade your fertilizer management. And then transaction cost, this is the cost that the farmer has to put in terms of time and effort in actually engaging with the whole process of learning about management improvement. So the opportunity cost and the compensation for exposure to increased risk come directly from those APSIM results. The opportunity cost comes directly from the difference in average cane yield between two cane practices. Let's say practice CF and practice BF. What's the difference, the predicted difference in average cane yield? How does that affect your opportunity cost? What's it costing you if you're down on cane yield, but you've presumably put less fertilizer on? You adjust for the reduction in the fertilizer expenditure. You see the reduction in the cane revenues, if there are any. And that's, you'd want at least compensation for that if you're going to make that change. Also, there's typically a concern that if you reduce your fertilizer applications, perhaps if a really good year comes along, you won't be able to maintain your, or to take full advantage, I guess, of that good year, and your crops will be lower in that year. So that's the compensation that you'd require for increased risk of not getting as high a yield if the year turns out to be really favorable. And I guess at the other end of the scale, perhaps if the year turns out to be really unfavorable, maybe you don't get as good a yield on that end either. So that was using the data from the year-specific predictions of cane yield. We were able to figure out the levels of compensation that farmers might require in particular management units for reductions in, increases in their exposure to risk of a lower than potential yield. Now, the transition costs and the transaction costs, they'll depend on farm size. You know, if you're investing in an expensive piece of equipment, but you've only got a small farm, the cost of that is spread over fewer hectares. Also, how many steps of improvement you can still make depends on the level of practice that you're starting at. And we didn't have data on which specific farms in which locations on which soil types were at which levels of practice. But we knew across the whole of a catchment what proportion of farms were at different levels of practice, and what proportions of farms were in the small, medium, and large size categories. So we were able to stochastically allocate our management units to farms of different sizes and to different initial practice levels to get an indication of the spread of costs and levels of DIN reduction that would be generated by these practice improvements. So to cut to the results on this one, what did the results look like? When we looked at the potential supply of DIN credits from fertilizer practice in change in cane, if we look at the graph we've got there, what we've done there is we've ordered the DIN credits from each of these land management units in the Johnson catchment from the least expensive change in terms of the change that would require the smallest compensation to persuade the farmer to do it, through to, on the far right-hand side, the most expensive change. And moving horizontally here, we're looking at the step reduction in DIN that follows from that change. The gray buzz that you see there, that's that stochastic simulation. So that's saying, what if different land blocks were starting at different levels of practice, and what if farms of different sizes were composed of land blocks of different soil types? So that gray buzz there that gives us the width, that's just taking account of some of the inherent variability there. I've drawn a blue line on it there. That's like a sort of a central line for the cost of credit supply. And I've also drawn a horizontal dotted black line there at $60 per kilogram DIN reduction at end of catchment. That's the level of cost that we'd be incurring once every land block in the catchment is already at that level of practice that broadly corresponds to the high spec whole of farm nitrogen budget. So if that's where the future starts as far as this project goes, it means that there are no DIN reductions available on this simulation, at least below about $60 per kg DIN at end of catchment. And also for the Johnson here, it's suggesting that slightly under 300 tons end of catchment DIN reduction might be available from that level of practice improvement. What happens beyond that? There's not much practice change left. There was only one further step of practice change. If you're looking to incur that further step, it's expensive and it doesn't actually give you much further DIN reduction. So very quickly, the costs of providing DIN reductions or the cost of supplying DIN credits from management change in cane very quickly get to be expensive, very expensive, rocketing up there above $100 up to $300 a kilogram. Once you've got everybody to that future where you've had full adoption of your full spec whole of farm nitrogen budget. So that's a worry if you're looking to supply cost-effective DIN credits for, let's say, sewage treatment plants or aquaculture or others to buy. It doesn't look like they're going to be coming from additional management practice change in cane. And the story is very similar for other wet tropics catchments. I just happen to have shown you the Johnson curve here, but the others are very similar. So then what else could we look at? Well, we could look at just taking cane land out of production. You can see on some soil types, there are some management units, the individual black dots there, where you've got a combination of high DIN losses because of the soil type and the soil permeability and the climate, but also relatively low cane yield. So if you took those out of production, you'd lose some cane yield, but you get quite a big reduction in DIN. What does that work out at? That works out at about $130 per kilogram DIN reduced at end of catchment. So that's still quite expensive. So what else could we do? Well, here we were very fortunate, as Nathan mentioned earlier, to be working in association with the Wet Tropics MIP, where they've been building, with Terrain and Australian Wetlands Consulting, have actually been building some wetlands specifically for nitrogen reduction in the Wet Tropics catchments, particularly the Tully and the Johnson. We've been very grateful to have had access to the emerging data on the construction costs of those wetlands. There are some data that are currently still being finally processed to give the DIN removal rates, but I haven't been able to include those here. So what I've done is I've taken the construction costs from those projects, and I've used some conservative estimates of DIN removal rates from the literature, which are actually lower than some of the rates Nathan put in front of us earlier. But what do we find? We find here that for what Australian Wetlands Consulting, Mark Bailey, termed landscape or embellished wetlands. So these are areas in the farm that were probably a bit wet already, something of a sump. There's a moderate amount of earth moving gone in there to just make them a bit more efficient as a nitrogen removal wetland. But if you look at the cost of those and the sorts of levels of DIN reduction that they can deliver, then it's looking like these wetlands can deliver DIN reductions from about $15 a kilogram DIN at end of catchment up to about 35. So that's, as Nathan mentioned, that's substantially cheaper than we appear to be able to get future reductions in DIN from further management practice improvement in cane. Also, there were some bioreactors that have been tested under the Wet Tropics MIP, and the most cost-effective of those seem to be coming back at around $60 a kilogram DIN. So it looks like these on-farm treatment systems can deliver DIN reductions that are starting from maybe $15 a kilogram DIN, and certainly comfortably by $35, $40 a kilogram DIN at end of catchment. And remember that there doesn't seem to be much DIN reduction available from further practice change at costs below sort of 50 or up towards $100 a kilogram DIN. So these appear to be very cost-effective options for our future once we've had full adoption of high levels of fertilizer practice in cane. I think I've just talked across this slide. So where did we get to with the supply side of DIN credits? We have only limited remaining supply of DIN credits from practice change in cane, anything from $60 a kilo if you're lucky, but rapidly rising up to $100+ a kilogram at end of catchment. The wetlands, potentially $15 to $35 a kilogram DIN. Bioreactors, maybe around the $60 a kilogram DIN mark on those initial results. Also, again, as Nathan mentioned, through some of the projects that we've worked on with Nathan, we looked at restored natural wetlands rather than specifically constructed wetlands, and they were very cost effective also, as good as, if not slightly better than, the constructed wetlands. We also looked at cattle fattening, low input cattle fattening, and some hardwood farm forestry, all of which, as alternative land uses, seem to be offering future supply of nitrogen reductions more cost effectively than pushing further than the levels of nitrogen practice in cane that would be required to satisfy your full spec whole of farm nitrogen budgets. Right, so that kind of ties down the supply side. We kind of know what's on offer there, or we got a feel for what's on offer. How much do you have to spend here to get at least a minimum estimate of how much you might have to spend per kilogram DIN to incentivize these landholders to change land management practice? Now, is anybody going to pay this much though? What's the demand for these nitrogen credits? So here we have to look across at who might be buying them, and the prime candidates here are the point sources that are operating under the Queensland Point Source Water Quality Offsets policy. So this would be sewage treatment plants, aquaculture expansion, abattoirs, things like this. And again, we were kindly given access to the data that detail the locations and discharge licenses for all these types of facilities. In fact, all along the Queensland coast. I've just shown a map here with them on the wet tropics. And there are two standout opportunities here. One is for the smaller, typically rural sewage treatment plants that are operating at somewhat older technology, where they're discharging about 30 milligrams of nitrogen per litre, whereas the newer plants are typically discharging around 5 milligrams of nitrogen per litre. But there are significant economies of scale effect in sewage treatment plant upgrading, so that make it very expensive to upgrade small treatment plants. So if we were looking to avoid these smaller plants having to upgrade at considerable cost to get themselves to that new level of discharge concentrations, they could potentially be buying nitrogen credits from, let's say, constructed wetlands or restored coastal wetlands in cane areas. The second type of treatment plant, or the second scenario where that mechanism could also be attractive, is if you're looking at your big urban treatment plants like Cairns, for example. They're already operating at full spec modern 5 milligrams nitrogen per litre type treatment. But if the population of the city continues to rise, that treatment plant will have to expand its capacity. So if by buying nitrogen credits for a modest period of time, 2 years, 3 years, 5 years maybe, they could actually just defer that expenditure, so they don't need to expand the capacity of that plant quite yet, but they could wait another 5 years for doing it, that actually would represent quite a saving. And so therefore that represents a cost that they could defer, and it enables us to figure out how much they would be willing to pay for nitrogen credits in order to defer that expenditure. I mentioned aquaculture here. Aquaculture is another potential purchaser of these credits, but I'm sure some of you will be aware that there's been quite a saga recently, or over preceding years really, around new aquaculture expansion, and it looks like, rather than using an offsetting approach, enhanced on-site treatment for new aquaculture, particularly around the macroalgae treatment, seems to be the way that the aquaculture industry and the regulator are going on that one. So aquaculture is a possibility here, but we haven't actually run the numbers for aquaculture, but we've run them for sewage treatment plants. And this is using data from Queensland Water, the Queensland Water Directorate, and they collect data on the costs of upgrading these different sewage treatment plants and on the loads and capacities of the different plants. So that allows us to see the level of expenditure that they would have to undertake to upgrade or to expand, and also how many kilograms of nitrogen credits would they have to buy if they were trying to avoid incurring those upgrading or expansion costs. And we had a look at that. Again, working with that delivery ratio that I mentioned earlier. So every kilogram of nitrogen that a point source sewage treatment plant wants to offset, it has to buy 1.5 kilograms of diffuse source nitrogen credit from, let's say, wetlands in a cane catchment. So when we put all those numbers together, what do we find? Well, we find that many of these sewage treatment plants would be willing to pay from the order of sort of $45 up to $100 a kilogram for DIN credits, and that would still be worth their while because of the savings that they would make in avoiding upgrading the smaller treatment plants. That's the ones down at the in the middle of the screen there in black. They're smaller treatment plants which would be looking to avoid the upgrading to the newer spec by buying nitrogen credits from the catchments in the long term. But then we've got some bigger, in the gray here, we've got some bigger urban treatment plants which would not be looking to, they don't need to increase their treatment performance, but they would be looking to defer the time at which they need to do their expansions. And there you can see, again, the willingness to pay from sort of $50, $100 or more, and some quite sizable quantities of DIN credits in tonnage there that might have to be purchased. So that takes us to the point where actually it looks like a DIN credit market could assist with facilitating ongoing population expansion, at least, and some economic expansion along the Reef coastline by providing more cost-effective mechanisms for upgrading or more cost-effective mechanisms than forcing sewage treatment plants to expand or upgrade, but still maintain reef water quality by virtue of the offsets that are purchased, particularly from farm wetlands or restored natural wetlands in cane-type catchments. There's more work that would have to be done on the science side around the delivery ratio and the environmental equivalency ratio. And I know that work is underway within Queensland DES, and I know some of my colleagues here at Griffith University, particularly Professor Michelle Burford, are very actively involved in that work at the moment. But I'm just flagging that as there's some science there that has to be fully tied down if you were to go down this path. But all the mechanisms are in place to allow this to happen through the Queensland Point Source Water Quality Offset Policy, and the the relative costs of supplying credits relative to the pricing which the buyers of the credits would potentially be willing to pay are such that there's an opportunity here to allow these credit purchase trades to happen and to be a win-win, both for the suppliers, the farmers, and the buyers, the sewage treatment plants. Oh yeah, I'm just keeping an eye on time here. This is just an illustration of why that delivery ratio, it needs to be perhaps considered. It's sitting at 1.5 to 1 at the moment. Here, we just looked at, by virtue of having those individual year data on the DIN reductions that come from practice change, we could see for all these different land management units on different soil types, if they go through a practice change, and the one I've shown here is from very old practice, DF, through to quite modern practice, BF, what level of DIN reduction do you get? And what's the variation in the level of the DIN reduction that you get from year to year, depending on the changes in the weather? And here we can see there's actually quite a lot of variation from year to year in the level of DIN reduction that that fixed practice change would give you. And that variation is different across different soil types. You can see here down the left-hand side. But if you wanted to be sure on the basis of these data that when you went from practice change DF to BF, you actually got a DIN reduction that was at least as big as the mean reduction that you got on that soil type for the DF to BF change, then you'd need to have delivery ratios in there that were at least 2 or pretty close to 2 or 2 on average. If you wanted to be sure that you got the mean level of DIN reduction 9 years out of 10, then you probably should be looking at a delivery ratio of 3 to 1. And at the moment, it's sitting there at 1.5 to 1. This is just a quick illustration, but it's just illustrating that that delivery ratio and the science around it needs to be considered. Let me move quickly on to sediment credits. Now, here again, we've benefited from new work that's emerging from the Landholders Driving Change MIP in the Bowen Bogey subcatchments in the Burdekin. And this is work on the cost effectiveness of large-scale gully remediation as a source of sediment reductions, or in our context, a source of sediment credits. And this is work that Andrew Brooks and colleagues have led and undertaken on behalf of Landholders Driving Change. It's very detailed work that uses LiDAR-based data to estimate, well, kind of measure really, I guess, to measure the levels of sediment loss from these gullies, and then with some on-ground actual remediation through Landholders Driving Change, you can see what level of sediment loss reduction you get after gullies have been remediated, and you've also got an indication of the costs of remediating those gullies. You put that information together and you get a supply curve like the one at the bottom of the screen here for the cost per ton of remediating these gullies. That's cost per ton over a 25-year period at a 7% discount rate. So this is the annualized cost per ton. Now, so that there are undoubtedly relatively cost-effective sources of sediment supply available, particularly through large-scale gully remediation. But is there any demand for sediment credits? Well, the primary source here would probably be from urban development through that state planning policy that we talked about earlier. It won't come from ports from their standard day-to-day dredging, what's called maintenance dredging. But if a port was expanding its facilities, then it would be looking to potentially purchase credits through the Reef Trust offset plan to offset sediment impacts from that port expansion. But we haven't got port expansion happening at the moment. And when we look at the populations of the major urban centres along the Reef coast, we haven't got much population increase either. So we haven't got much, at the moment, we haven't got much demand for new urban development. So although we've got a relatively low cost source of sediment reductions, currently we don't have a particular demand to purchase those sediment credits. Of course, that could change if post-COVID, the economy takes off again up the Reef coast, populations increase, tourism facilities are being constructed along the coastline, etc. So you could imagine situations in which there would be a need for sediment credits. And although at the moment they're not there, but there would appear to be a source of relatively cost-effective source of sediment credits from gully remediation, particularly in the Bow and Bogey subcatchments in the Burdekin, but something similar will probably be available from the Fitzroy and elsewhere. So, where did that take us to? Well, it took us to the point where we said, our main question, can trading in water quality credits provide a cost-effective pathway for future economic expansion along the Reef coast without jeopardizing reef water quality? Well, yes, potentially it can. The conditions seem to be there at the moment around a DIN credit market. There's a relatively cost-effective source of sediment credits for a sediment market, but there's not currently a demand side for that. But the mechanisms are in place, so I think that's the good news. The mechanisms are in place, and the costs of supplying credits relative to how much buyers might be prepared to pay for those credits all stack up. Credits can be supplied at lower cost than buyers would be willing to pay. So there's an opportunity for both buyers and suppliers to gain, to benefit from that transaction. And that's good news. That's very good news, because what we're looking to do there is to try and underpin future economic expansion without driving a cart and horses through the hard-won gains in reef water quality. But just for the last few minutes here, I want to look at some of the mechanisms, the actual configurations of markets and funding that we might need to make this work. Because certainly the economics literature, it's full of lots of descriptions about why water quality trading markets should be a wonderful thing. And it's also full of lots of descriptions of why they haven't got off the ground successfully, why they failed. So here's some suggestions about the type of market configuration that might be useful for bringing this thing to fruition. And one of the big learnings from that literature is that these markets will not emerge spontaneously. There's really got to be some quite active steering and initiation of the markets, typically from government, to get them off the ground. And the reason for that's pretty straightforward to see, particularly if we're thinking about land use changes like wetland construction, or maybe hardwood forestry going in some places, or remediation of large sort of engineering type remediation of large gullies. They're all capital intensive up front. You got to put a lot of money in up front in the hope that when you generate some sediment or nitrogen credits, somebody is going to buy them. And clearly that's a very risky proposition for a project proponent. So the mechanism here to do that would be effectively to use government-derived funding. We'll come to the sources of that in a minute, but imagine government putting a significant block of funding into something that might be called a credit investment fund, which could be used to kickstart this mechanism by funding those wetland conversions, funding those gully remediations with on-ground suppliers. So this would be landholders or proponents on ground. Those land use changes would take place. Sediment and nitrogen reductions would result and would have to be validated, obviously, to the satisfaction of the environmental regulator. But then those credits could sit there in credit ledgers, perhaps, waiting to be purchased by the buyers. The buyers here on the right-hand side of this diagram, the buyers are these environmental authority holders operating point source emitters, operating under the Queensland point source water quality offset policies. This is the sewage treatment plants, particularly maybe the aquaculture plants. They can buy those credits. The revenue from the credit sale goes back into that investment fund, builds it up a bit further, and you can work around that cycle. The other element that we've got here, though, is those fee in lieu funds that are currently coming into state planning policy for urban development and coming into the Reef Trust offset fund for developments along the coastline. Those funds, the intention of those funds is to purchase sediment or nitrogen or biodiversity offsets in the catchments. So those funds could ultimately potentially go into that credit investment fund. They could be contributed to that credit investment fund. So that could provide a large amount of the kickstart revenue we need. You could also look to other mechanisms to help generate that kickstart revenue. The government here has a lot to gain, the state government and the federal government, but perhaps particularly the state government has a lot to gain from facilitating ongoing economic expansion along the Reef coast. There's jobs, there's economic activity. So that to some extent those could to some extent be considered as public goods. Everybody's going to benefit from those additional jobs and the additional economic activities. So state government could put some of their own money into this credit investment fund. There are other entities, though, who would sit downstream in our catchments who would also benefit, particularly from sediment reductions. Water supply providers would. They don't have to remove as much sediment from the drinking water. Ports potentially would, because perhaps they wouldn't have to dredge so often. They would have to do some science to be sure about that. But potentially, those downstream beneficiaries could contribute into that credit investment fund as well. Just to give an indication of the scale of that, if we look along the Reef coastline and we look just at ports who have to dredge annually or with a 2 to 5 year frequency, so the ports we're looking at there would be Cairns, Townsville, Mackay, Hay Point and Gladstone. Those ports play a big role in export of key commodities from Queensland: alumina, aluminium, coal, liquefied natural gas and sugar. And typically the value, the traded value being shipped out of those ports is just short of, well, a bit more than 30 billion a year. So if there were to be some reductions in the dredging costs of those ports, it might be possible to consider a modest levy on those trades that could also feed back into this credit investment fund. Now, I'm not saying this has to happen, of course. I'm just looking for other mechanisms through which broader beneficiaries of these, particularly sediment reductions, could actually contribute to pay for the cost savings that they would ultimately realize. So almost finished now. I just wanted to get to a final point here, because all of the discussion we've had so far and all of the thrust of this project has been around this future in which there's economic expansion and we're trying to hold the line with these water quality improvements. We're looking for cost-effective economic expansion with no net decline in water quality. So that's the top half of this diagram that we were looking at previously. So that diagram we had here is the upper half of this diagram. But as everybody's well aware, there are other private market investment funds marshaled by Green Collar that are looking to buy not credits to offset future developments along the Reef coastline. So offsetting here just holds the line. It doesn't actually reduce sediment or nitrogen loads. It just makes sure that economic expansion can happen without sediment or nitrogen loads increasing. the green collar reef credit type mechanism does essentially the same thing. It looks to reduce sediment and nitrogen by incentivizing landholders to change their land management practices or change their land uses to reduce sediment and nitrogen loads at end of catchment. The key difference with the green collar mechanism is the nature of the buyers. The buyers for the green collar type reef credits would essentially not be emitters of sediment or nitrogen to the reef. The sort of buyers who've been talked about, and Qantas have been talked about, other companies, Palmolive I think has been talked about, where they're looking to buy into the saving the reef aesthetic really. So if sediment and nitrogen reductions are purchased from land management practice changes or land use changes, and then those there's no offsetting required, so there's no further emissions from the buyers of those credits, then you're actually driving reef water quality in the right direction. You're actually improving reef water quality, not just holding the line. So I think what we've actually got here in combination, we've got a mechanism which would incentivize significant changes in probably most likely land use, and often through the wetlands route that Nathan was talking about earlier, incentivizing re-establishment of wetlands or construction of wetlands or remediation of gullies perhaps in GBR catchments. We've got one mechanism from which those credits from those actions could be purchased in order to hold the line to prevent further reductions in, to make sure we don't have any reduction in reef water quality with economic expansion. That's the upper part of the diagram. And in the lower part of the diagram, through the reef credits type mechanisms, if those credits are purchased by entities that don't themselves emit nitrogen or sediment, then that's actually going to be acting to drive, to improve reef water quality. So in summary here, I think that there's a future here for these water quality credit trading markets for both of the reasons that are outlined on this slide. What it does tell you is it's going to be an exciting time potentially to be a supplier of these credits, because you could be trying to sell them into sewage treatment plants, aquaculture facilities, or you could be supplying them to Qantas effectively through the reef credit loop. So I think there's important messaging that we could be looking at here around the opportunities that these type of credit mechanisms offer for landholders in reef catchments. It's not a completely done deal yet. Most of this project has been somewhat crystal ball looking into the future, and there's some science that we've outlined here that still needs to be done around the delivery ratios, environmental equivalency ratios, things like that. That's a particular concern for the regulator on the water quality side of things on the top half of this diagram. It's perhaps not so much of a concern for the bottom half. But I think that was the messaging we had here, that there are real opportunities to be had here, and water quality credit trading markets, I'm convinced, have a role to play in helping improve reef water quality, but also facilitate economic expansion once those improvements in reef water quality have been delivered. So again, thank you very much to the project's funders here. That's the Queensland Government Office of the Great Barrier Reef and the Australian Government National Environmental Science Programme. Thank you to all of the collaborators in other reef projects in the MIPS and elsewhere that very kindly shared the information and data with us that allowed us to put this this overview together. And thank you very much, everybody, for listening. I'm very grateful that you've sat through that. Some of that got a bit technical, but I'm very happy to deal with any questions or comments. Thank you.
Thank you, Jim, for that great presentation and outlining some of those avenues for opportunity. We've got two questions here. I'll go to the first one from Chris Johnson. He's asked, what makes up the $130 per kilogram DIN from setting aside cane? Jim, so you might need to go back a few slides for that one, but he's just asked $130 per kilo BIN from setting aside cane.
Yes, thanks, Chris, for that question. Okay, that was this one here. So what we did there was we identified individual management units in some of the wet tropics catchments that have relatively low cane yield but relatively high DIN loss. And we said there, okay, well, what if we just, as they do in Europe, you effectively pay the farmer not to grow cane on that block. So in that case, the farmer would lose the revenues from the cane, the net revenues from the cane, and would need full compensation for the full amount of that. He would probably, in fact, need a little bit more than that because he probably still wants to do some sort of weed management on the block. But essentially, it's the foregone net revenue from the cane divided by the number of kilograms of DIN reduction that not growing cane on that block would deliver. So that's where that comes from, Chris. I can go through that in more detail again with you and show you the calculations, but has that helped?
Thanks, Jim. Yeah, he says, thanks, Jim. And the final question, Jim, from Alex Garzon is, how do you see the inclusion/treatment of different nutrient fractions like particulate nitrogen as part of the credits, considering that particulate nitrogen becomes dissolved in organic nitrogen further down the catchment or in reef coastal environments? Yes,
thank you very much for that, Alex. That's one of the things I didn't put in detail in this presentation at all, but it's very important. And that, as you well know, I mean, you're right at the forefront of this research. There will be some catchments along the reef coast where reductions in nitrogen will probably have to come via reductions in fine sediment. I mean, we might have noticed one of the sewage treatment plants that potentially would be looking to buy a significant amount of nitrogen reduction would be the big plants in Rockhampton on the Fitzroy. There's not a lot of cane in the Fitzroy. The main way that those treatment plants would be looking to buy DIN offsets would be via the sediment reductions that might be achieved in the Fitzroy catchment in the grazing areas, possibly through gully remediation. So that's exactly up your alley there. That's in order for that to work to the satisfaction of the environmental regulator, then the type of work that Alex is doing and other colleagues to try and identify exactly how the bioactive fraction of fine sediment is reduced when gullies are remediated. That would be central to this, because it would essentially be setting up that environmental equivalency ratio that we talked about in the point source water quality offsets policy. So it has to be in there, Alex. That's a key piece of work, and that would be one of the pieces of work that I would very strongly recommend that the government continues to fund if they want to make these types of mechanism environmentally robust and acceptable to the environmental regulators.
Thanks, Jim. And finally, we've got another question here from Chris again. He's asked, would a shift in delivery ratio from 1.5 to 1 to 3 blow out the costs of that STP?
Yes, that's a key question, Chris. What would happen there is if we step back to why are the STPs looking to buy here? They're looking to buy to either avoid the costs of upgrading if they're one of the smaller ones, or defer the costs of capacity expansion if they're maybe one of the big urban ones. So that the cost of upgrading, let's say, to a rural STP, that's a fixed amount of money. So they don't want to spend more than that amount of money on purchasing credits. Now, if we crank the delivery ratio up to 3 to 1 instead of 1.5 to 1, they're going to have to purchase twice as many credits as they would otherwise have done. So if they've only got a fixed amount of money to spend, the amount they're willing to pay per credit is going to come down. So that's where a balance has to be found in terms of that delivery ratio between environmental integrity. You want to try and make sure that the offset is going to actually cover the excess emissions most of the time. So we've got to balance that, the environmental integrity, against the dampening effect that a high delivery ratio would have on the amount per credit that a buyer would be willing to pay. And that's what we spent a little bit of time in the report, at least looking at it along these sort of lines. I think a single whole of Queensland delivery ratio might not be the way to go, but maybe location and or soil type specific delivery ratios might be the way to go. Because as we can see here, this was just for a practice change on cane, which is about as straightforward a way of reducing DIN as we could come up with. Even for that very straightforward DIN reduction, the level of delivery ratio you'd have to put in place to ensure environmental integrity varies across the different soil types. So a one-size-fits-all delivery ratio, with a one-size-fits-all delivery ratio, it'll be difficult to get that balance right between environmental integrity and avoiding the dampening effect on the buyer's side of the market. So I think there's more work to be done there on that one.
Thanks, Jim. We've got another question here from Ray, just asking when you think your final report will be finalised and published, given its use in the upcoming investments.
Right, thank you. It is with my independent reviewers now, Ray. They told me they would have it back by the end of this week. So depends on what they say. If they're relatively happy with it, then by the end of November, we'll have this ready to go. If they want something significant change, then that might take me a little bit longer. But I'm hopeful that we'll get through the independent review. So it's very imminent now. That review should be back with me this week from 2 independent reviewers.
Great. And Jim, was a time frame used in calculating the transition costs to producers?
Yes, there certainly was. Let me think about that. Yep. We definitely will have done it. We'll have spread that cost over. I'm just trying to remember whether we spread it over 1 cane cycle or 2. So it would either have been probably 6 years or 12 years for the wet tropics. I think I'll have to check, so I can come back to the questioner with that one. But I suspect that we spread it over just 1 cane cycle. So I think the transition cost might have been spread only over 6 years, discounted at 7% per year to give us an annualized cost. But I may be wrong. It may be 12 years, not 6, and I should check on that so I can send a clarification through.
Thanks, Jim. And final question on this chat, by the looks of things, what are the dollars per kilogram for dissolved inorganic nitrogen reduction from STP via engineering solutions? And
yeah,
Robin says, apologies if I missed that.
No, that's good. That's a good question. That is where our estimates of how much the STPs would be willing to pay has come from. That came from data from the Queensland Water Directorate, which they published in these reports, actually. They published data on the costs of upgrading sewage treatment plants of different sizes. And so that's your engineering cost of the upgrade. And what I'm doing here, where we're looking at how much would they be willing to pay, I'm looking at the costs of delivering these equivalent DIN reductions via the engineering. So it depends on the size of the plant that you're dealing with. Bigger plants will be lower cost per kilogram DIN. smaller plants will be the higher costs, and the costs that we see here are the combined capital cost for expansion, the capex, and the higher opex, the higher operating costs for the higher spec plants. So it's the capex plus opex increments for the engineering improvements to reduce the DIN. So it, broadly speaking, from kind of $50 a kilogram DIN up to 100 for the smaller plants on the older technologies. For the bigger plants where you're already at new technology, but you're just deferring the cost of expanding that plant. It's expensive. These are big plants, so a big capacity expansion is very expensive. Just deferring those costs into the future take you to these sort of costs here, so upwards of $100, $150 per kilogram DIN. And again, I can provide more information on that for the specific questioner if they're interested how we did that. That's actually explained in the report.